We're back with Jamie Murray, Portfolio Manager and Head of Research of the Murray Wealth Group. And this is great. Jamie, thanks for sticking with us. We're getting a roundup of stocks whose companies are reporting results. Canada Goose has been out of favour, but it looks like the picture brightening up there.
Yeah, Canada Goose, so they reported, as you were talking at the top of the hour, a little bit better results from China. The luxury market globally has been pretty slow the last year and a half. So they've been affected by that. I also think we've seen very, very warm winters the last 3-4 years, and there's no reason to go buy a big parka if you're going to be wearing a light jacket most of the winter in most of North America. So
it's been kind of tropical, as you know, in Toronto the last few days.
Yeah, it was 26 degrees in New York yesterday, I think. So there's not that push to get the consumer out the door to buy their products. They've tried to diversify into more lighter knitwear products. I think that's been mixed in terms of success. And I mean, Canada Goose, I think the long-term growth all is in Asia, China, and also the other Korea, other Asian nations. So they need to make further inroads there. But we really need to see just like a more sustained sales growth acceleration out of this company. The luxury market, like I said, it's been mixed, but generally the hotter brands have been growing the last 3-4 years, and Canada Goose hasn't seen the same growth rate. So we need to see more growth to see the stock really turn around.
Superior Plus, a big distributor of propane, among other things, but it has been investing in the States. It bought a Texas-centric company not so long ago, and finally cutting the dividend.
Yeah, so it finally cut the dividend. I'm a little surprised by the reaction because it was telegraphed even by some of the Bay Street analysts indicating this was a potential this quarter, but it just goes to show any dividend cut is going to be sold. So being ahead of that is not where you typically want to be positioned. And yeah, again, warm weather in North America, that's hurting propane sales. And the acquisition they did in Texas for this company called Certarus, we weren't big fans of the acquisition. We viewed it as a very commoditized business. It's really no different than a lot of these oil and gas service companies where you buy a piece of equipment that's not proprietary to you. Other companies are out there buying these equipment. And it just seems like there's been margin pressure from too much overcapacity.
Yeah, I think that in Texas, they're into compressed natural gas and other things.
Yeah, that's exactly what they do. So you can replace some different types of fuels with natural gas on location. And I think it's a longer term, there is a good growth opportunity in this business, but it's very cyclical with supply and demand, as many of these types of businesses are.
And then finally, European residential REIT. You say this is an unusual situation. Why do you find it interesting?
Yeah, so this is one of our larger holdings in our income fund. And European residential REIT, the long and short of it is, it owns Dutch multifamily and residential properties, such as your basic landlord. It's 65% owned by Cap REIT in Canada, so the large apartment building owner here. And in the summer, Cap REIT it's trading at a big discount to its net asset value, so the individual properties are worth more than what the units are trading at. And in the summer, Cap REIT said, we want to sell whatever we can. We're going to extract as much value out of this company. We're going to try and sell these assets at their NAV, and we're trading below it. And if we do that, we can extract, we think, north of $4 a share. And this is when the stock was trading at $250, $260. They announced several large deals in September, and the stock started to move up on that. But then we saw it pull back again the last week. And this, again, was just a company where it's like, they're telling you they're going to sell all these properties for hopefully north of $4 for the whole company. And they're very motivated to do it. And the Dutch property market's very, very strong, stronger than the Canadian. There's no reason why they shouldn't be able to execute on this. And then today, they just changed some language in the trust structure. There's going to be a special meeting to give them blank slate to just sell whatever properties they want without unit holder approval. And so that's pushed the units up to a fresh 52-week high. We still think an investor will get north of $4 in this, so there's more to go. But we think it's easy, low-risk money sitting there.
So I got a bit confused there. So Cap REIT, apparently they have about 12% of the company, but maybe I'm out of date there.
Yeah, no, I think they actually own more than 50%. I think it's around mid-60s. Okay. And Cap REIT in the last year or 2 years is now managing European REIT. So the same Mark Kenny, the CEO, is managing European REIT as well.
Sure. So I'm just looking here at the holders list. Yeah, it must be through some other entity or something. Yeah,
it could be.
And so what's this about $4? So the shares are about $3.50 right now.
So shares are about $3.50. Just the reported IFRS, the accounting standards NAV, the net asset value, is $4.50.
Oh, I see.
So if they can sell these properties at what they're saying market value is, it should turn out to be $4.50 a share for unit holders. I mean, now you might want to discount that back just because not every property maybe is going to get what they think it's going to get, but they're very committed to getting close to that NAV. And the last sales they did were actually above that net asset value. So looking good for getting a $4 to $4.50 out of this company by, I think it'll be by as early as next summer.
Finally, we're tight for time, but Propel Holdings, they provide credit, or a fintech, to other companies, I think actually extend the loans to their customers. Stock hitting a record high today.
Yeah, so this is a newer company that we've just purchased in the last couple of weeks, actually. We met the CEO last year. Actually, we met the CEO here on BNN on the morning segment, and we met up for another meeting after and followed the company for the last year. And yeah, so they do lending, online lending to subprime and below subprime consumers. So very high risk consumers. They charge higher rates because these are generally their customers can't access credit from traditional lenders. They hope to build those consumers' credits and move them up into bigger loans at better rates over time. And it's just a phenomenally managed company that has very, very strong return on equity. They reported today the results were great. They've increased their dividend every quarter this year. And what brought us over the top to buying the shares was, especially after they tripled this year, was they're doing an acquisition in the UK of a company called Quidmarket, which is a similar company to them, but maybe a little less sophisticated on some of the back-end technology that they use to underwrite their loans. And so we just think it's a great, well-run company that seems to have a model that works. And, we're excited to see what they can do over the next couple of years.
Jamie, thanks very much indeed. Jamie Murray, Portfolio Manager and Head of Research.